Welcome back. Tough macroeconomic conditions have overshadowed Growthpoint's strong operational performance. During the interim period, the property group reported an 8.6% decline in distributable income per share. And it doesn't expect things to get any better, warning of a 10 to 12% decline in DIPS moving forward. And joining me now is the company's group CEO, Norbert Sasse. Thank you so much for your time, Norbert. Let's actually start off with that distributable income per share that took some pressure. What was the decrease weighted on?
Yeah, look, I think at the beginning of the year, we guided for, 10 to 15% down. So I think this first half at minus 8.6 is probably a little bit better than what we had expected. But we do believe that the second half is still going to remain challenging with, with higher interest rates, impacting the income statement, not only in South Africa, but also in our international investments, in particular in Australia. Now, it's important to note that when I talk second half, I'm talking second half of our financial year, which takes us to June. So all the noise about interest rates coming down and reductions of 100 basis points potentially to between June and December fall within our next financial year, so it won't impact this financial year. So I would say, if I did the numbers, I'd say about 80% of the, let's say, reduction in distributable income is directly attributable to higher interest rates across our businesses in the various jurisdictions that we're in. As you pointed out in your introduction, operationally, things are actually not bad. If I look at the key performance indicators, let's call it the direct property metrics, while some of them might still be negative, they're less negative than they were. In particular, let's say, rental reversions in South Africa. Vacancies have improved across, all the different jurisdictions that we're in. Rental renewal rates, in terms of the success of rental renewals, are pretty firm. And so, it really is a sort of a tale of two distinct issues. One is pretty decent operational performance, but on the other hand, the financial side being impacted mainly by interest rates, but also, notwithstanding these improved operational performances, things are still tough. We're still struggling with load shedding and diesel recovery and inefficient municipalities and costs increasing faster than what revenues are increasing.
And actually quite interesting, because I zoomed into your SA operations, and of course something that you'd expect is an increase in vacancies in office because the economy is still tough, but we actually saw the opposite. But what was interesting is that we saw an increase in vacancies in industrial property, and I'm wondering what was responsible for that.
Yeah, so that's a little bit sort of a self-inflicted injury. We do some developments, in order to gain additional exposure to industrial, which is arguably the better performing sector of the three, rather than just going out and trying to buy, industrial assets. We've got a very good development team, and we did develop, I think it's in the order of 60,000 square meters or so of additional industrial assets. Now, not all of those were pre-committed up front. Some of them were, let's call it, speculative. We've done well in doing some speculative developments and then letting them. But as at the 31 December date, a number of those were completed but weren't let. So we've added a bit to that vacancy factor almost through our own actions, rather than a weakening of the dynamics in the sector.
And it's really also just quite pleasing to see that the V&A waterfront performance is still booming. Let's actually cross over to your offshore operations. How did that picture look like?
It's a bit of a mixed bag. I have to say that, Australia, if you look at the dividend that we're reflecting, that we received from Australia, it probably belies a relatively, in terms of history, a weak performance out of Australia. And I think there are two factors there. They're suffering from exactly the same as the South African business with regards to interest rates, probably even a little bit more given the extent to which interest rates rose off a ridiculously low base in Australia over this period. But also the fact that they weren't probably as hedged as we were. We've always been sort of 75% or more hedged. At the time that the interest rates started rising, they were probably only about 55% hedged. So they've been hedging on the way up, and that's also caught them a little bit offside. The other number that distorts their number is the fact that in the prior reporting period, there was a very big lease cancellation fee that we received from one of the tenants in the order of $15 million. So that boosted the last reporting period's result, and therefore now looks like this period we did particularly badly. So it's a little bit distorted. So that's Australia. Eastern Europe, they put out some results on Monday, Globalworth. Again, pretty robust operational performance, vacancies dropping from 14.7% to 12, just in the low 12s. Revenues are reasonably strong, letting strong. Once again, the issue is really debt, and in particular for Globalworth is the future debt refinance that is pending. The company has 2 bonds that are listed, and they've got to refinance those bonds. The bond market in Europe is not that supportive yet, and so the company is really going all out to accumulate liquidity through asset sales, through raising new loans and drawing down and hoarding the cash, which is obviously costing them in terms of earnings. So whilst the earnings was pretty weak, the operational side was strong. And then Capital and Regional, they released results on Friday last week, and a very solid set of results actually. Their improved dividend coming out of the UK for us there. They are impacted by the weak UK economy and by the, let's say, the consumer in the UK being under pressure. But all things considered, a pretty decent set of results. If anything, on the front foot, we managed to acquire one asset and in Scotland, a Gyle, and raised a bit of equity, and it's turned out to be a pretty good acquisition, and we've done some good letting there.
All right. Well, I mean, let's talk about your capital expenditure. Where is your capex focus on in the short to medium term?
So look, I think capital is constrained, capital is expensive, and we're sort of guarding it. We are looking to dispose of some assets to bring in some additional capital to invest into some of our developments. We've got about a 1.6 billion rand local development program, which we have to complete. This includes a new head office for 91 down in Cape Town. It includes a new hotel in the Longcliffe Studios precinct. And it includes the redevelopment of a shopping centre down in Cape Town called Bayside Mall. So we've got some capital there. We have reinvested our dividends into Globalworth. We have reinvested our dividends into Capital and Regional. So we still like offshore. But the fact of the matter is, capital is in short supply and it's expensive. So if anything, we'd like to probably manage our debt down a little bit as well as part of our decision making.
All right. Well, we have run out of time. Thank you so much for your time and just outlining those numbers that came out from Growthpoint this morning. That was the Group CEO of Growthpoint, Norbert Sasse.